In a dramatic turn of events that sent shockwaves through the cryptocurrency markets, Bitcoin has fallen below the critical $100,000 threshold for the first time since late June 2025. The world's largest cryptocurrency dropped to a low of $97,956 earlier today, marking a significant psychological breach for investors who've watched BTC maintain this level for months. This isn't just another dip in the volatile crypto market. With over $500 million in liquidations in the past 24 hours and market sentiment plunging to extreme fear levels, traders and investors are asking the critical question: is this a temporary correction or the beginning of something bigger? I'm going to break down exactly what triggered this massive sell-off, what the data is telling us right now, and most importantly, what experts are forecasting for Bitcoin in the coming weeks. Whether you're a seasoned trader or just watching from the sidelines, understanding what's happening right now could be crucial for your crypto strategy. Let's start with what actually happened. Bitcoin officially dipped below $100,000 today, with some exchanges reporting lows in the high 97,000 range. This marks Bitcoin's weakest position since late June, when the broader crypto market experienced a significant correction. For context, Bitcoin had been struggling to maintain key support zones over the past several days. Earlier this week, BTC failed to hold the $110,000 to $112,000 range, and the downward pressure has been building ever since. Today's breach of the $100,000 level isn't just a number on a chart. It represents a critical psychological barrier that the market has been watching intensely. The market reaction was swift and brutal. Liquidations topped $500 million over the past 24 hours, with long positions bearing the brunt of the damage. In just the last hour alone, $140 million was liquidated, with 98% of that coming from traders betting on higher prices. These forced liquidations created a domino effect, adding fuel to the downward momentum. Bitcoin's market cap briefly dropped below $2 trillion during the sell-off, and the broader crypto market shed over $300 billion in value. Major altcoins followed Bitcoin's lead, with Ethereum down over 4%, XRP falling more than 5%, and Solana dropping nearly 4% in the same period. So what exactly triggered this massive sell-off? It's not just one factor, but a perfect storm of pressures converging at once. First, let's talk about institutional outflows. Bitcoin exchange-traded funds, or ETFs, have been hemorrhaging capital. After recording a brief $240 million inflow on November 7th, ending a 6-day outflow streak, the momentum quickly reversed. By November 12th, spot Bitcoin ETFs saw negative $278 million in outflows. November has been particularly brutal for U.S. spot Bitcoin ETFs, with $661 million in net outflows so far. This is a stark reversal from October and September, which saw $3.53 billion and $3.42 billion in inflows respectively. This dramatic shift in institutional sentiment is a major red flag that's hard to ignore. The second major factor is the macroeconomic environment. Despite the U.S. government shutdown ending, which many traders expected would boost market sentiment, the opposite occurred. This turned into a classic sell the news event. The government shutdown actually created what analysts are calling a liquidity drain. The federal government ran a fiscal surplus in recent months, meaning less money flowing into the markets. Market analyst Mel Madison noted that we've had one of the driest periods for fiscal liquidity in months, if not years. The shutdown temporarily narrowed those deficits, removing the stimulus that risk assets like Bitcoin typically feed on. The third trigger is the Federal Reserve's stance on interest rates. There's growing uncertainty around whether the Fed will cut rates in December. Earlier comments from Fed officials suggesting a potential cooling of the rate-cutting cycle have caused risk assets to stumble. Remember, Bitcoin and cryptocurrencies tend to perform better in low-interest rate environments, as they make riskier assets more attractive compared to safe haven investments. Finally, there's significant selling pressure from long-term holders. On-chain data shows that Bitcoin whales and long-term holders have been distributing their holdings more aggressively than usual into this weakness, helping to cap any attempted rebounds. When the smart money starts selling, it often signals that they're expecting lower prices ahead. Now let's dive into what the charts are telling us. From a technical standpoint, Bitcoin is showing some concerning patterns that traders need to watch closely. Bitcoin has broken below multiple support levels. The $100,000 to $102,000 range has now flipped from support to resistance. This means that unless Bitcoin can reclaim this zone with strong volume, any attempts to push back above $100,000 will likely be short-lived. The next key support level to watch is around $99,000, followed by the $97,500 to $95,000 area. If buying pressure doesn't materialize at these levels, we could see Bitcoin testing even lower support zones. Technical analysts are pointing to several bearish signals. The market value to realized value ratio, or MVRV, is forming a bearish divergence. This metric tracks unrealized profit across the Bitcoin network and suggests that buyers have taken a more cautious approach this cycle. This could explain why we're seeing significantly less accumulation action compared to previous bull runs. Some analysts are also warning about a potential death cross formation on Bitcoin's exponential moving averages. This occurs when the short-term EMA crosses below the long-term EMA, typically signaling a sustained downtrend. In the past 2 years, Bitcoin has narrowly avoided such a crossover 4 times. However, each of those instances was followed by notable corrections, with average declines ranging between 21 and 23%. There's also a head and shoulders pattern forming on the daily chart, which is historically a bearish reversal pattern. If this pattern completes, it could signal further downside ahead. On the indicator side, the relative strength index is sitting at around 41.69 on the daily chart, indicating neutral conditions. This means Bitcoin isn't technically oversold yet, suggesting there could be more room to fall before we see a significant bounce. The Chaikin money flow indicator shows that outflows are currently dominating, with investor outflows hitting a 16-month high. This is a clear sign of weakening momentum and rising risk aversion among traders. Let's talk about something that's often overlooked but incredibly important: market sentiment. And right now, the sentiment couldn't be more bearish. The crypto fear and greed index has plunged to 24, firmly in extreme fear territory. This is the lowest level we've seen in months. Just 30 days ago, this same index was sitting at 60, which indicated greed. This massive swing from greed to extreme fear in just 1 month shows how quickly sentiment can shift in the crypto markets. The Fear and Greed Index aggregates multiple data points, including volatility, momentum, social media activity, Bitcoin dominance, and Google Trends. When all these factors align to show extreme fear, it typically means traders are anxious, retail investors are capitulating, and panic selling is occurring. Historically, extreme fear readings can actually be contrarian indicators. Some of the best buying opportunities have occurred when everyone is fearful and selling. However, that doesn't mean the bottom is in. Sentiment can remain in extreme fear for extended periods, especially during bear market phases. Social media chatter has exploded around Bitcoin's drop below $100,000. Crypto Twitter is filled with debates about whether this is the beginning of a deeper correction or just a healthy pullback in an ongoing bull market. The uncertainty itself is contributing to the fearful atmosphere. Trading volumes have also surged, with the total crypto market seeing $195 billion in 24-hour volume. High volume during a sell-off often indicates capitulation, where weak hands are being shaken out of their positions. Bitcoin dominance has remained relatively stable at around 58%, suggesting that while the entire crypto market is down, Bitcoin is still holding its position as the market leader. Ethereum's dominance sits at 11.4%. Interestingly, the altcoin season index has dropped to just 22 out of 100, its lowest level in over 90 days. This means traders are fleeing altcoins faster than Bitcoin, seeking relative safety in the largest and most liquid cryptocurrency. So what are the experts saying about all this? Let's break down some key perspectives from market analysts and what they're forecasting. On the bearish side, several analysts are warning that Bitcoin could retest the $91,000 to $97,000 support range. The MVRV ratio's bearish divergence suggests buyer fatigue, which historically has led to deeper corrections. Some technical analysts are even pointing to potential support levels as low as $70,000 to $75,000 if key support zones fail, though this is considered an extreme scenario. However, not everyone is doom and gloom. Many analysts believe Bitcoin's broader uptrend remains intact despite this pullback. Stan Lowe from GRVT stated that BTC remains structurally bullish for now given the rate-cutting environment, though facing short-term bearish pressure driven by macro factors. Andriy Fauzan-Adzima from crypto exchange Bitrue offered an even more optimistic view, saying, "This is merely the fourth correction in the 2025 bull cycle, not the onset of a prolonged winter. ETF outflows, a hawkish Fed, and retail capitulation are simply temporary purges following October's euphoria." He added that historical data shows every 20+% drawdown in a bull market typically sparks a 40+% rebound within 60 days. If this pattern holds, we could see Bitcoin recover significantly by early 2026. The liquidity argument is also interesting. Market watcher Mel Madison noted that while we're experiencing one of the driest periods for fiscal liquidity in months, the floodgates are about to open. He suggests that the Trump administration is going to unleash a tsunami of fiscal largesse in coming quarters, especially with midterms needing to be defended. If this liquidity injection materializes, it could provide strong tailwinds for Bitcoin and risk assets generally. Several analysts maintain that the fundamental thesis for Bitcoin remains strong. The halving that occurred earlier in 2025 reduced new supply, creating a supply shock that historically has led to price appreciation in the 12 to 18 months following the event. We're still within that window. Additionally, institutional adoption continues to grow despite the recent ETF outflows. Major corporations continue to hold Bitcoin on their balance sheets, and more financial institutions are offering crypto services to their clients. Looking at the next few weeks specifically, what can we expect? Let's break down the various scenarios and their probabilities. In the immediate short term, the next 24 to 72 hours are critical. Bitcoin needs to reclaim and hold the $100,000 level with strong volume to reverse the bearish momentum. If it can do that, we could see a quick recovery back toward the $104,000 to $106,000 range. However, if Bitcoin fails to reclaim $100,000 and continues to trade below it, the next major support zones to watch are $97,000, then $95,000. A break below $95,000 could trigger another wave of liquidations and panic selling, potentially pushing Bitcoin down to test the $90,000 level. Various forecasting models offer different perspectives on where Bitcoin might trade over the next week to month. Some technical prediction models suggest Bitcoin could trade between $91,000 and $108,000 over the next 2 weeks, with significant volatility in between. The bearish case for the next few weeks points to continued consolidation or even lower prices. With the Federal Reserve meeting in December approaching, uncertainty around rate cuts could keep a lid on Bitcoin's upside. If the Fed signals a pause in rate cuts or indicates a more hawkish stance, we could see Bitcoin test lower support levels. The neutral case suggests Bitcoin will likely consolidate in a range between $95,000 and $105,000 for the next several weeks as the market digests recent moves and awaits clearer macroeconomic signals. This choppy, range-bound trading could frustrate both bulls and bears. The bullish case argues that this is simply a healthy correction in an ongoing bull market. If institutional buying returns, particularly through ETF inflows, we could see a sharp reversal. Remember, extreme fear readings have historically marked good buying opportunities. If sentiment shifts and buyers step in at these levels, Bitcoin could quickly recover and make new attempts at the $110,000 level. One factor to watch closely is the end of the U.S. government shutdown. As government spending resumes and fiscal liquidity returns to the markets, this could provide fuel for risk assets, including Bitcoin. The timing of this liquidity injection could determine whether we see a recovery in the coming weeks or if the pain continues. Zooming out to a longer time horizon, what does the rest of 2025 and early 2026 look like for Bitcoin? Despite the current weakness, many analysts remain optimistic about Bitcoin's prospects for the remainder of 2025. Several forecasting models suggest Bitcoin could reach between $130,000 and $150,000 by year-end if conditions improve. This would require a significant reversal in sentiment and a return of institutional buying through ETFs. The bull case for late 2025 rests on several pillars. First, historical post-halving cycles suggest that Bitcoin tends to make strong moves 12 to 18 months after the halving event. We're currently in that window. Second, if the Federal Reserve does cut rates in December or signals a more dovish stance for early 2026, that could reignite demand for risk assets. Third, the supply dynamics remain favorable. With only 19.94 million Bitcoin currently in circulation out of the 21 million maximum supply, we're approaching peak scarcity. As more coins get locked up in long-term holdings and institutional vehicles, the available supply for trading continues to shrink. Looking into 2026, the consensus among analysts who remain bullish is that Bitcoin could challenge and potentially exceed its previous all-time highs. Some forecasts suggest a range of $150,000 to $200,000 is possible by mid to late 2026 if the bull market continues. The cycle theory perspective suggests that Bitcoin is still in the early to middle stages of this bull cycle. If history rhymes, we could see Bitcoin peak sometime in late 2026 or early 2027, potentially reaching valuations that seem impossible today. However, it's important to acknowledge the risks. If we're wrong about the cycle timing, if macroeconomic conditions worsen significantly, or if there's unexpected regulatory crackdown, Bitcoin could enter a prolonged consolidation phase or even a bear market. The key variables to watch are Federal Reserve policy, institutional adoption rates, regulatory developments, and global economic conditions. Several long-term forecasting models paint wildly different pictures. Conservative models suggest Bitcoin could trade between $80,000 and $150,000 throughout 2025. More aggressive models predict Bitcoin could reach $200,000 to $300,000 by 2027 as adoption accelerates. Some notable figures in the crypto space, like Cathie Wood from ARK Invest, have long-term targets as high as $1 million per Bitcoin by 2030. Though most analysts view this as extremely optimistic and unlikely to materialize within that time frame. So, where does this leave us? Bitcoin's drop below $100,000 is significant. There's no denying that. It represents a clear shift in short-term sentiment and raises important questions about whether the bull market is still intact. The immediate outlook for the next few weeks is uncertain and likely to be volatile. We could see Bitcoin consolidate between $95,000 and $105,000 as the market finds its footing, or we could see another leg down if support levels fail and panic selling accelerates. However, many of the long-term fundamentals that attracted institutional and retail investors to Bitcoin in the first place remain intact. The supply is fixed and diminishing as we approach the 21 million coin cap. Institutional adoption continues to grow despite temporary ETF outflows. And the narrative of Bitcoin as digital gold and a hedge against inflation remains compelling to many investors. The key takeaway is this: markets move in cycles, and corrections are a healthy and normal part of those cycles. Whether you view this as a buying opportunity or a warning sign depends on your time horizon, risk tolerance, and conviction in Bitcoin's long-term value proposition. For traders, the next few weeks will be critical. Watch those key support and resistance levels. Pay attention to ETF flows, Fed communications, and broader market sentiment. Use proper risk management and don't over-leverage in this volatile environment. For long-term investors, this could be one of those moments where patience and conviction are rewarded. History shows that some of the best buying opportunities occur when sentiment is at its worst and everyone is fearful. One thing is certain: the next few weeks and months will be crucial in determining whether Bitcoin can reclaim its upward trajectory or if we're in for a longer period of consolidation. Stay informed, stay disciplined, and remember that in crypto markets, volatility is the only constant. If you found this analysis helpful, Make sure to follow for more updates as this story develops. The Bitcoin market never sleeps, and neither should your awareness of what's happening. Until next time, trade smart and stay safe out there.